Let's discuss accounting basics that are important for tax preparation. Accounting is the language of business. No matter the accounting method or type of business entity, a business must keep good accounting records. Good records allow you and the business owner to understand what is happening in his business on a regular basis. It is vital that businesses keep records from the day they start operating. There are 3 rules regarding record keeping that I recommend to every new business owner. First, keep personal and business funds separate by opening a business bank account. Don't deposit business income into a personal bank account, and don't write business checks from the personal checkbook or vice versa. Secondly, keep an accurate record of business transactions daily or weekly. At least once a week, a business owner needs to record all the deposits and withdrawals from a bank account along with the source and purpose of the transaction. If the owner waits much longer than 7 days, he's likely to forget who gave him the money or why he wrote the check. Finally, the third rule is to review the financial results of the business each month. The important thing to remember is that accounting activities by themselves are not important. They're important only because they provide useful information. Here are some accounting records and reports that need to be maintained. The general ledger contains the financial activities of each account within the chart of accounts and is used to prepare financial statements and other reports. It is this ledger that ensures debits equal credits, which is what we mean when we say the books balance. Every transaction coming in or going out during the business year is recorded in a general ledger in some fashion. The more professional, the better. It is a business's fundamental database. No other financial reports exist without it. Certain business aspects have unique record-keeping requirements. They include listed property, travel, transportation, entertainment, and gifts, and backup withholding. Let's discuss listed property first. Listed property is certain equipment which lends itself very easily to personal use as determined by the Internal Revenue Code. Deductions for listed property are not allowed unless adequate purchase and maintenance records were kept. This includes the amount and description of all costs related to the listed property, including purchases, repairs, maintenance, or improvements to each property. Also, the amount of business use of the listed property is paramount. You need to show how much the listed property was used for business, such as the amount of time it was used for or the number of miles it was driven. The date and purpose of each business use must be recorded as well. If these rules are not met, deductions may not be allowed. In addition, if the business use of these items is 50% or less of the total use, the deduction is limited. Automobiles are probably the most common example of listed property. Automobile expenses can be accounted for in 2 ways, using either a standard mileage rate or actual cost. To figure the standard mileage rate, the number of business miles is multiplied by a fixed amount determined each year by the IRS. The actual cost method requires more extensive record keeping. The owner must keep receipts for all gasoline and oil purchases, repairs, insurance, license fees, tires, and any other related expense. Also, the tax preparer needs to determine the vehicle's depreciation. There are annual limits that apply to automobile depreciation, so be careful when calculating that. The total of all expenses is then multiplied by the business use percentage to arrive at the actual automobile expense deduction. Tolls, parking expenses, and a percentage of property taxes and interest paid for the vehicle for business use are fully deductible and are added to the other automobile expenses using either method. How about travel, transportation, entertainment, and gifts? Well, all that should be recorded in a log. Receipts should be kept for any travel expense or gift that is given, particularly if the expense is $75 or more. A receipt is always required for lodging, regardless of the amount. A credit card statement is not sufficient evidence of a lodging expense. 2 critical accounting reports should be generated monthly. One is the income statement, and the other is the balance sheet. Let's discuss the income statement first. This report summarizes performance during a certain period of time. Sales and expenses are matched during the same time period. An income statement, also known as a profit and loss statement, or abbreviated as P&L, is a report that totals all money inflows and outflows by account during a specific period, usually a month, a quarter, or a year. Its primary purpose is to show whether or not the business earned a profit for that period of time. A company earns a profit, also known as net income, if its revenue exceeds its expenses. The income statement includes sales, or the total revenue coming into the business, cost of goods sold, or all the costs associated with purchasing or producing items for sale to customers, and gross profit, which is sales minus the cost of goods sold. Then expenses are subtracted from that gross profit number. These include marketing, general, and administrative expenses. Other income is then added, other expenses subtracted, and the result is net profit or loss. Let me give you an example. This is one showing a profit or net income. The income statement for the XYZ company summarizes performance from January 1st through December 31st for this particular year. Let's say sales are $50,000. Cost of goods sold is $15,000, resulting in a gross profit of $35,000. Next, we subtract the expenses, which were $20,000. There were no other income or other expense items. They had a net profit of $15,000. Now, if the same statement showed $50,000 worth of sales and $30,000 worth of cost of goods sold, the resulting gross profit would be $20,000. And if the company had expenses of $27,000, then they would have shown a net loss of $7,000. With an accurate income statement in hand, the tax preparation is significantly simplified. The balance sheet is another important accounting report that is calculated on a regular basis. This report is usually compiled on a monthly basis and provides a financial picture of the business at one moment in time. A balance sheet uses the equation assets equal liabilities plus capital to create a picture of business's financial health. The purpose is to help key players understand the company's financial status as of a given date. For example, if a company has total assets of $200,000 and liabilities of $80,000, then their capital will always be $120,000. You should review the sample balance sheet in your workbook. It will give you good insight into how a balance sheet is created. If a company has more liabilities than assets, it may not be able to pay its debts, especially when they are larger than the potential funds available to pay them. However, on the other hand, if the assets are much greater than the liabilities, it is more likely that the business will be able to repay any debts it may incur. The balance sheet, with the income statement, provides an accurate picture of what is happening in the business. As a professional tax preparer, the balance sheet and the income statement become a valuable resource when filling out the business tax return.